But let's kickstart the show by talking about the big news that came through overnight, which is that the Federal Reserve decided to hold rates in its June policy meeting, in line with expectations, of course. But, the commentary remained very hawkish. It has hinted at 2 more rate hikes later this year. That's in 2023. Let's listen into the Fed Chair's comments that came through post the policy announcement.
Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
All right, so those important comments coming in from US Fed Chair, and of course global markets eyed those movements very, very closely. So yes, a pause this time, but hinting at more rate hikes and a hawkish stance. How do we read into it and the takeaways from that? Latha Venkatesh is right here to put that all into perspective. Latha.
Yes, clearly it was an as-expected pause, and the statement offered only one justification for why the rates were not hiked or cut, and that is it was to allow the committee to assess incoming data and their impact on policy. So that's why we turn to the so-called dot plot. Now, what is the dot plot? This is a chart on which all the 18 members vote on how many more hikes they see. And just look at the split. 9 of these 18 members have voted for 2 more hikes. Let's look at all the votes, and you will get an idea of how it's not just hawkish, but even more hawkish. There was only one asking for only 1 hike, but just 4 members. 9 members asking for 2 hikes. 2 of them asking for 3 more hikes, and 1 of them asking for 4 more hikes. And there were just 2 people saying that no more hikes are needed. The Fed statement is also accompanied by what is called new macro projections. It's called Summary of Economic Projections, or SEP. Now, the Fed has actually upped its growth forecast for the 4th quarter from earlier 0.4% to now 1%. That's a huge jump in the growth forecast. Also, it has lowered the expected unemployment by the year end from earlier 4.5 to 4.1%. So again, showing strength of the economy to employ more people. Core inflation is again expected to get worse to 3.9% versus an earlier forecast of 3.6%. The only thing which showed moderation was the headline CPI, which is now cut to 3.2%. The earlier forecast was 3.3%. What were the key takeaways from the Powell press conference? Well, the only dovish statement he made was July is still a live meeting, and the members did not decide conclusively about July in the June meeting. That's about all he said. Now, for the hawkish part of the statement, it was how he scorched all hopes of any cuts in the current year, 2023. Nearly all members expect that we have to hike somewhat this year, was what Powell said. Now, what will make them cut? Powell gave some indications. He says the impact of the hikes is there, but the committee needs to see 1, more growth slowdown. 2, labor market to loosen up, and 3, supply lines to get better. He expects the first disinflation signs to come from the housing market, especially from the new lease rentals. He also said that more than 1 year of rate hikes have not yet worked through the economy. All said and done, for me, the biggest takeaway is that growth is very strong. Let's prepare for higher growth forecasts even for our country.
All right, Latha, thanks a lot for wrapping up all of that action and all of those comments that really came through from the US Fed chair. But with that, we are also going to bring you some opinion because we caught up with Ed Yardeni of Yardeni Research. We spoke with Bank of America's Aditya Bhave as well as Citi's Robert Sorkin to get their take on the policy and how the Fed could really move from here. Listen in.
The big surprise was that they indicated that they will be hiking interest rates some more. I thought that, I wasn't really that surprised. I thought that they would take a hawkish position on the future while taking a relatively dovish position for now. I'm not convinced that they're going to be doing 2 more rate hikes. I think between now and the next meeting in late July, a lot can happen. And I think we're going to continue to see moderation in the inflation rate, moderation in the labor market. So I don't really know that more rate hiking is actually necessary.
Ultimately, we do expect the Fed to hike in July. And then once again in September or November, Powell had a chance to validate the July hike a little more strongly, and he didn't, which is why markets have not fully priced in even 1 more hike, never mind 2. So we have a similar view on growth. We really think that the recession next year will be quite soft. In fact, it'll be within range of what you would just call a technical recession or essentially a soft landing.
A few months ago, we shifted out our view of when the U.S. economy is likely to go into recession from Q3 of this year to Q4 of this year. And that's really based on the resilience that we've seen in the labor market and overall economy over the last several months. And, given the continued strength that we're seeing, I think there's even a debate if Q4 is too early to expect a recession. Now, we do think eventually some type of technical recession is needed to soften the labor market, to soften the feed through into services, wages and services prices that's driving a lot of the services inflation we're seeing. But where we are right now, it's hard to see the U.S. economy going into any type of sharp slowdown until at least the end of this year.